Singapore's economy grew better than expected in the fourth quarter, but at a slower pace than the previous quarter. Advanced data just released show GDP rose 4.3% on year in the October to December quarter. That's slightly higher than analysts' estimates. Full year growth was lifted to 4%, exceeding the official forecast of an expansion of around 3.5%. On quarter, GDP grew 0.1% for the period, moderating from the third quarter's reading. Growth was fueled mainly by the manufacturing sector, which expanded 4.2% on year. The electronics cluster and transport engineering clusters were the main contributors for growth in the manufacturing sector. And let's take a look at the Singapore dollar at the moment, now at 136 against the greenback. We'll bring you the rest of the market reaction when the SDI opens in the next hour. Before analysis, let's bring in Brian Tan, head of non-China EM Asia economics research at Barclays. Brian, thanks for your time today. So better on year and slower on quarter. What's your read on how Singapore fared?
I would say if you look at the numbers that we've been getting recently, we had a very strong third quarter, which didn't look like it was going to be sustained. Today, we've seen that those numbers come down to 4.3% from over 5% in the third quarter. I think you are seeing the signs that the economy is peaking in 2024, and we're entering 2025 still on a relatively solid footing, at least in the fourth quarter of last year. But still, the horizon is cloudy. And given what we know about the incoming U.S. administration and their threats to already put tariffs in place on their trading partners, it is going to be, I think, a relatively challenging 2025 compared to 2024.
So you're expecting, challenges ahead for Singapore's economy. We know of the challenges externally, but when you take a look at the sectors in the country, manufacturing helped in the last quarter. Are there pockets of strength that you expect to help support strength or growth for Singapore this year?
Right now, the electronic sector is still holding up, and that remains a bright spot. Clearly, as we get into 2025, the AI story is still something that's playing out. And while Singapore does not directly have linkages to the AI segment of the tech industry, it pick up in the semiconductor cycle overall because of the tech story. I think that should continue to be a boon to the Singapore manufacturing sector. The services side as well, I think for now at least, remains quite resilient. But I would say, look, Singapore is an ultra open economy. As we head into 2025, as the year unfurls, I think that as we get these tariffs and trade barriers that are put in place, as the global trade tensions increase, that is likely to crimp on growth in Singapore.
Yeah, I want to also bring up the Prime Minister's New Year's message. Prime Minister Lawrence Wong said that the strong economy will allow real incomes to rise further to outpace inflation. Inflation has slowed here in Singapore. Prices, though, have not come down. So to what extent do you think wages can relieve inflationary pressures for consumers?
I would say that's probably what our numbers are also showing right now. So as we've gone in towards the end of 2024, we've seen inflation come down quite significantly. Now, that does not mean that prices are falling. Inflation is still positive, which means that it is still increasing, but the pace at which it is increasing has come down quite a bit. And as we get into 2025, we do think that the pace of inflation, especially once you exclude private road transport, which includes cars and accommodation, basically the MAS's measure of core inflation, these numbers should remain relatively modest and subdued in 2025. And as a result, as long as wage growth, I think, remains broadly within historical averages, you should see overall wage growth outpace inflation. So prices may be going up, but wages should overall be going up by more. So consumers should be better off.
Yeah, and That will be a relief for sure for a lot of workers here, Brian. But when we take a look at the US dollar, that's expected to strengthen this year. What will that mean for the Singapore dollar, and what are you expecting from the MAS now that the US is expected to have a slower pace of rate cuts?
I think the issue here is that if the US is experiencing a slower pace of rate cuts, that means that inflation over there is going to be holding up relatively more solidly than we expected, and that growth as well is not tanking. So, in that kind of environment, we do think the MAS can see some scope to ease monetary policy settings as early as January, not so much because I think the global economy is hurt, or that the local inflation is particularly low, but I think it's a situation where the MAS can normalize its policy settings. We've gone the last few years with a relatively tight monetary policy stance, and as a result, with inflation coming down, not collapsing but coming down back within target ranges at least, we do think that the MAS will see an opportunity here to normalize some of their policy settings with a measured calibration and easing of the monetary policy settings at the end of January.
All right, Brian, appreciate your instant analysis today. Brian Tan, there, head of non-China EM Asia Economics Research at Barclays.